I'm Susan McGinnis in the Energy News Center. Both natural gas and crude oil prices fell this week. Natural gas slipping about 5 cents thanks to ballooning inventories. Meantime, oil slipped below $65 a barrel earlier in the week on speculation Europe's debt crisis will hurt the global recovery and crimp demand. Joining us today for some more insight is Elliott Gue. He's editor of the Energy Letter and the Energy Strategist. Good morning, Elliott.
Morning.
Congratulations on your recent matrimony.
Well, thank you very much.
It's good to see you again. Let me get your take first on the Gulf oil spill. Any impact, a longer short term on prices?
Sure. I mean, I think the longer term impact is going to be higher prices. What you're going to see is some disruption of production from the Gulf, but I think more importantly, you're definitely going to see a lot more regulation of deep water drilling and drilling generally in the Gulf of Mexico. That's going to tend to push up prices.
And how permanent will that be? Will that only be when this spill, a rare event but catastrophic, is still fresh in our minds?
No, I mean, I think you're going to see kind of long-lasting effects in terms of regulation. You saw that after the Exxon Valdez incident. The big thing to come out of that was basically the banning of single-hull tankers and sort of the whole industry moving over to double-hull tankers. And I think you're going to see, in this instance, you're probably going to see regulations that require newer rigs being used in the Gulf. You're probably going to see newer equipment needed to be installed in a lot of these rigs, and that's expensive, and it's going to probably push up prices.
But for now, it's down, down, down. We had crude down 20% just for this month. It's down below 70 right now. This is mid-morning on Friday. What's your sense? Some are calling for $60 a barrel by the end of the year.
I think what we're looking at in the crude oil market is basically the crude oil market's following the stock market. It's following basically what's going on in Europe. And the fear is that the debt crisis that started in Greece and sort of started to spread to Portugal and Spain and even to Italy is going to eventually infect the interbank market, much like we saw back in 2008, and is really going to hurt the corporate credit market as well. And when you have that kind of contagion, that sort of global contagion, you have a situation where you could have something like we saw back in 2008, and of course that would hurt. That would basically kill the entire global recovery we've been seeing. And I think that's what the crude oil market's worried about. I think that they're overreacting to it a little bit. We haven't really seen much contagion. We've seen most of the worst of the credit crunch this time around has been confined to the sort of periphery of Europe. The German market's still pretty solid in terms of credit, and the U.S. market's the interbank market really not much of an effect at all. So I think it's a lot more isolated than the market thinks.
Okay, looking at natural gas, we have continued abundancy on that front.
Yes,
So the latest report talking about a 17% higher stockpile than the 5-year average. How is the situation there?
Well, the natural gas prices have been pretty depressed, and they're kind of hanging here in the $4 area. However, they really haven't moved much, and since this whole crisis started, oil has come plummeting down. Natural gas is trading basically where it was before this whole crisis started.
So not following the equity markets as much?
Not so much, because I think gas is just so depressed anyway. And people had already sort of written it off as too much gas in inventory. The story's been out there for months now. So the market just hasn't reacted as much. One thing that we are seeing in the gas market I think is very interesting is just a humongous surge in industrial demand for gas. And part of that, of course, is
and
the
that's like a third of total U.S. gas use?
Absolutely. It's about 35%. And that is all basically the manufacturing part of the economy recovering very quickly in the U.S. We're actually seeing higher industrial demand for gas than we saw before the whole credit crisis and recession.
So what will that do for the overall price by the end of the year? Do you still see it stuck below $5?
The problem is we still have excessive inventories, and it's going to take a while to work that off. It's going to mean lower production has to happen at some point. We're going to have to see increased demand, but it's certainly on the margin a helpful thing. I don't think natural gas prices are going to drop much below the current range. If a global crisis and a credit crunch can't get gas below 4, I don't see what will.
Right.
So I think we're going to kind of hang in this area. The upside would come, probably not until the autumn or winter when we start to see, heating demand come back. The other thing that could affect it, I think, is this summer. If we see a big surge in electricity demand,
we're supposed to see a warmer summer in some areas of the country, and that would boost demand.
Absolutely, and last summer was a very cool summer in the United States. So if this is a more normal summer, I think you're going to see a lot of gas demand because you've already seen a lot of utilities switching from coal and natural gas. That coupled with a warmer or warmer than average summer, you could see a big pull on gas, and that could get gas prices moving again over the summer.
Okay, we'll keep watching that. Elliott Gue from the Energy Strategist, thank you.
Thanks for having me.
And I'm Susan McGinnis in the Energy News Center.